Welcome to our explainer. Have you ever looked at one of those massive, sprawling corporate empires and just thought, how in the world did they afford to build all this? Well, today we are fully decoding the corporate finance blueprint. We're going to break down the exact strategies these giant joint stock companies use to raise capital, survive the tough times, and ultimately dominate the market.
Here is our roadmap for today. We'll start with an intro to capital formation, move into owned capital and the role of owners, check out the power of retained earnings, dive into borrowed capital and external funds, and then wrap up with a showdown between owned versus borrowed capital. Let's get into it.
So really think about the sheer scale of a modern joint stock company for a second. Every single move they make, right from the very first day of promotion down to their day-to-day operations, burns through cash. The capital requirements are absolutely massive. So how exactly do they keep that engine running?
Let's kick things off with Section 1, Intro to Capital Formation. At the very foundation of everything we're exploring today is this concept of capital formation. Simply put, it is the process of collecting funds from various sources to meet a company's specific financial plan. And I mean, without successfully gathering this capital, a joint stock company literally never gets off the ground. It's step one.
And a massive chunk of this financial magic happens in real-world arenas, like the National Stock Exchange. This is the ultimate crossroads where companies execute those financial plans, connecting directly with savers, households, and big institutions to secure the funds they desperately need to grow.
When you strip away all the complexity, every single rupee a company raises falls into one of two main buckets, or pillars. You've got owned capital, which involves things like issuing shares or holding on to past earnings, and then you have borrowed capital, which leans on tools like debentures, bonds, and public deposits. Moving right along to Section 2, Owned Capital and the Owners Who Provide It.
The absolute crucial takeaway here: permanence. Owned capital is literally the lifeblood of a new company. Shareholders purchase shares, supply the funds, and boom, they become the owners. Because they own a piece of the pie, this money stays with the company for its entire life. It is only ever refunded at the very end, during what's called winding up, which is basically when a company is completely liquidated or closes its doors.
Now, it's important to realize not all owners are the same. You've essentially got two very different investor personalities. Equity shareholders are your fundamental risk takers. Their dividends fluctuate based on how much profit is made, but they get normal voting rights to actually steer the company. On the flip side, preference shareholders are cautious. They want safety. So they get a fixed dividend and priority repayment if the company goes under, but they generally trade away their voting rights in exchange for that peace of mind.
All right, let's look at Section 3. The power of retained earnings.
I love thinking about retained earnings as the ultimate corporate piggy bank, what some textbook definitions call the plowing back of profit. Instead of handing all the net profit back to shareholders as cash dividends, a smart management team stashes a portion of it in a reserve fund. They then reinvest it right back into the business. It's an incredibly powerful and basically free internal source of growth for established companies.
So what actually determines how much cash a company can squirrel away? Well, it boils down to a four-way tug of war. First, total earnings. Obviously, more profit means more potential savings. Second is tax policy. Heavy government taxes simply eat away at those corporate savings. Third is the board's dividend policy. Conservative boards prefer saving over giving out massive payouts. And finally, government control, because strict regulations can legally limit how much a company is even allowed to distribute in the first place.
Switching gears, we hit Section 4, borrowed capital and external funds.
When a company wants to expand aggressively, they usually have to look outward. But borrowed capital is, well, exactly that, borrowed. Once a public company secures its certificate to commence business, it can take on short, medium, or long-term debt. But here is the massive catch. This money comes with a strict expiration date. Plus, the fixed interest must be paid on time, every time, even if the company is bleeding money.
Companies actually have a massive arsenal of debt instruments to choose from here. They can issue debentures, accept public deposits, or rely on traditional bank loans and trade credit directly from their own suppliers. They can even look way beyond their borders using ADRs and GDRs, American and Global Depository Receipts, which allows them to tap into foreign stock markets. It is a vast ecosystem totally designed for leverage.
Finally, we arrive at Section 5. The ultimate showdown of owned versus borrowed capital.
When you place these two pillars side by side, the contrast is pretty striking. Shareholders are your true owners. They contribute capital in exchange for voting rights and a slice of those fluctuating profits, but they have absolutely no secure claim on the company's assets. Creditors, on the other hand, provide the borrowed capital and give up their voting rights entirely. In exchange, they get the safety of fixed interest, strict repayment timelines, and usually a secured charge on the company's assets to protect their money. A truly skilled finance manager has to perfectly balance this scale to minimize costs while maximizing growth.
So, I want to leave you with this final thought. If you were putting your own hard-earned money into this massive corporate machine, where would you stand? Would you choose the safety and fixed returns of a secured creditor, or do you want the voting power and the ultimate risk and reward thrill of being an equity owner? Understanding these fundamental sources of finance really decodes the business world around us. Thanks for joining me on this explainer today, and keep questioning how the financial empires around you are truly built.